We're living in an information age, with information flowing 247, and sometimes we even experience information overload. And that's why we need to consider the role of social media in shaping stock market sentiments and volatility. The role of social media in shaping, our stock market sentiments as well as volatility, as the topic of this particular video. Social media has become a powerful influence on stock market sentiments and volatility. Very powerful, you know. So here is how it impacts the market. I want to consider how social media impacts the markets. Number one is rapid information sharing. Rapid information sharing. So social media platforms like Twitter, like Reddit, like Facebook, allows information to spread quickly, including rumors. Unfortunately, news and opinions. Even rumors tend to be spread faster than normal. So this fast dissemination can cause rapid changes in the market sentiments, sometimes leading to sharp price movements based on non-fundamental factors. That's the problem. Based on non-fundamental factors, just rumors, news, whatsoever driving the markets. And the fundamental remains intact. But the investors are carried away by what they hear, not by what they can see and experience, and which of course is not the right way of investing. Number two is amplification of sentiments. Amplification of sentiments. Generally, sentiments, have been, in the market right from time immemorial. But because of this particular information each, sentiment tends to be expanded, amplified. It's amplified kind of. So posts from influential users, or groups can amplify market sentiments. Positive news can trigger buying sprees, while negative comments, or discussions can spark panic selling. For example, platforms like Reddit, Wall Street bets can have been known to significantly impact stock, stock prices, as we saw in the popular case of GameStop in 2001. That's issue that involved GameStop. We were buying and buying. It was this short position a particular individual took on GameStop and all these things. It was a very popular, news item at that time. Number three is herd mentality. Herd mentality. So social media can encourage herd mentality, where large group of investors, follow, a particular sentiment without independent analysis. They just follow, without sitting down to critically and at an individual level analyzing, critical facts. They just follow, like a herd. So this collective decision making can lead to market volatility, as stocks can rapidly become overbought or oversold due to mass participation. So the market, participants can really determine, stock movement depending on the volume. If they are big enough and they take a particular action, discover that it will really have an impact on the markets. So the heart could be powerful. We can't afford to ignore the heart. Although they may not be right always, but the fact that they can really influence the market is something we should watch out for. Number four is viral trends and memes. Viral trends and memes. Is this particular issue of meme stocks? So memes and viral trends, can create speculative bubbles. Stocks or assets discussed heavily on social media, may experience sudden surge in prices, often disconnected from the underlying fundamentals. Because of the prevalence of discussion, interest in a particular stock, the stock price may pick up momentum that is may not really be in consonance with the company's fundamentals. This can result in short-term volatility and market distortion. Please like this video and subscribe to this channel. It will do me a ton of good. It doesn't really cost anything to just subscribe. It will not take minutes, just seconds. You've subscribed and then you like this video. All right. Just encourage me because it's not easy to to be sharing this with you. Just encourage me, okay? And then by subscribing to this channel, it's not easy to be a content creator. And our only kind of reward for now is to see the subscription level going up. Please be a factor for progress, right? Number 5 is retail investor influence. Retail investor influence. So social media gives retail investors a platform to share investment ideas, sometimes influencing market trends that were once dominated by institutional investors. Now, you discover that the market is democratized now. What used to be the playing field for institutional investors, now what retail investors are partaking in. So this democratization of information can increase market volatility, and as retail investors often act, on sentiment-driven impulse. They act based on sentiments. They will disregard fundamentals in the short run. In the short term, they just carry out activities and decisions based on temporary sentiments. Number 6 is sentiment analysis. Sentiment analysis. So investors and analysts increasingly use social media sentiment analysis tools to gauge market mood. Positive or negative sentiment expressed in large volumes online can provide insights into potential market movement. Just analyze the market sentiment. We can do that accurately. That will give you an indicator whether to sell your position, to hold, or to even buy more, depending on the result of the analysis you've carried out. So in summary, social media plays a crucial role in shaping stock market sentiments and can lead to increased volatility. Investors need to be cautious of the influence of social media and use critical thinking when making investment decisions based on online trends. But you can consume the information, but take your time, critically, analyze market fundamentals, critically analyze, the company you are invested in. Look at the balance sheet, the cash flow statement, the income statement, and make your decision based on, real facts, real fundamentals, not just on what is prevalent in the market, prevailing news and rumors, in the markets. You need to consider that.